with minutes left in today's trades, is now the time to buy AT&T. We're not saying you should buy something in 4 minutes, but yeah, we kind of are. Alpine Funds portfolio manager Mark Spellman says, what on AT&T?
We like AT&T. I think, you know, it's the old, slow, boring AT&T, which I think is exactly a good stock in this kind of slow.
Yeah, for widows and orphans, they used to say.
And I think smarter people who are looking for nice, steady growth, a low interest rate environment, slow economic growth. This is a stock now that has a yield of 2.5 times the U.S. Treasury 10-year bond. I mean, that's amazing. They did a lot of acquisitions. You just mentioned DirecTV. Going forward in 2016, it's going to be concentrating on synergies, revenue synergies. I think the setup is pretty good. We like it in our Alpine Rising Dividend Fund.
They have made some gutsy moves. However, there are people who are constantly looking for the next sort of hotter thing. And, you know, you talk about T-Mobile, John Ledger, and the always colorful CEO of T-Mobile says, we're coming out with a drinking game during AT&T's conference call. Of course, it's just a gimmick, but they say that, you know, you're supposed to take a drink every time AT&T mentions things like profitable growth and bundling. I mean, look, it's a way to get attention, but maybe investors are trying to find something that's a little sexier than just the old boring story.
You got to just be careful, I think. I mean, I think we all agree, certainly rates at 2%. It's a low growth, low rate environment. If I can get a stock with a balance sheet that good, I don't think they're going to be spending a ton of money this year, and I'm going to get a yield of 5.5%. I think that's a great position to have in a portfolio.
With that dividend is always nice. Why the reversal in the markets today? We're up 250 plus points right now for the Dow.
Well, I think there's an interesting, highly correlated with oil prices for sure. I'm not sure that that's going to last for a long time because it's very unusual. We have like a 96-97% correlation with oil. I think at some point that's going to split and we're going to decouple away from oil. We're heavily into the earnings season. You saw it through this morning, Procter & Gamble and Johnson & Johnson, two companies that have a lot of overseas dollar exposure. They actually did pretty good. I mean, Procter & Gamble had 2% organic sales growth. That was a lot better than people thought.
Give me the signposts that our viewers should look for before they go all in to buy a lot of stock.
I think there's 4 characteristics, or a bunch of characteristics, I'll say. First of all, look for U.S. domestic revenue sources. Look for low debt balance sheets. Look for a healthy dividend that can be supported going forward and hopefully rising. That's what I think is really going to pay off in the next 6 to 9 months. You've got $2 billion in assets under management. I'm listening to you. Thank you so much, Mark. Great to see you. Thanks for having me. Mark Spellman.